I can explain the implications of change to the weighted average cost of capital, WACC. Understand the components and purpose of the weighted average cost of capital. The weighted average cost of capital, WACC, represents the average return required by an organization's providers of finance, weighted according to the proportion of debt and equity used in the capital structure. It reflects the opportunity cost of investing capital in the business rather than in alternative investments of similar risk. WACC is commonly used as the discount rate in capital investment appraisal methods such as net present value, NPV. Management accountants must understand how the cost of equity, cost of debt, and tax effects contribute to the overall WACC. In management case study scenarios, candidates should recognize that WACC serves as a benchmark for evaluating whether investments generate sufficient returns to create shareholder value. Explain how changes in capital structure affect WACC and investment decisions. Changes in the mix of debt and equity financing can significantly affect the WACC. Increasing the proportion of debt may initially reduce WACC because interest payments are tax-deductible and debt is generally cheaper than equity. However, excessive leverage increases financial risk, which may raise both the cost of debt and the cost of equity. This can eventually increase the WACC. Management accountants analyze how different financing structures influence the organization's cost of capital and financial risk profile. In management case study contexts, candidates should explain how financing choices affect investment appraisal outcomes and whether proposed capital investments remain financially viable under different capital structures. Assess the impact of market conditions and business risk on WACC. The WACC is influenced not only by capital structure, but also by broader market conditions and business risk. Changes in interest rates, investor expectations, inflation, and macroeconomic conditions can affect both the cost of debt and the cost of equity. In addition, increases in operational or strategic risk, such as entering new markets, adopting new technologies, or undertaking acquisitions, may raise investors' required returns. Management accountants must therefore consider how these factors influence the discount rate used in investment appraisal. In management case study responses, candidates should recognize that changes in risk or market conditions can alter the organization's cost of capital and affect project evaluation. Evaluate the strategic and financial implications of changes in WACC. Changes in WACC can significantly influence strategic investment decisions and organizational value creation. A lower WACC reduces the discount rate applied to future cash flows, potentially making more investment projects financially attractive. Conversely, a higher WACC increases the hurdle rate for investments and may lead to the rejection of projects that were previously viable. Management accountants therefore analyze how shifts in financing strategy, risk profile, or market conditions affect investment planning, corporate valuation, and long-term financial strategy. In management case study scenarios, candidates should demonstrate the ability to interpret WACC changes and explain their implications for capital allocation and organizational growth.